The official history of the 1980s Latin American debt crisis is a simple story. Countries borrowed too much, interest rates spiked, and the International Monetary Fund, the IMF, had to step in to save them. They call it a necessary intervention. They claim it brought stability. But that official narrative is a structural lie. The reality is that for an entire generation across Latin America, the IMF didn't bring a cure, it brought a plague. A plague of austerity that wiped out national sovereignty and systematically transferred billions in wealth to the West. So, what if the debt crisis, the lost decade, was not an accident of poor national planning, but the engineered consequence of a deliberate financial trap? What if the IMF's structural adjustment programs were the secret legal mechanism designed not to stabilize economies, but to force sovereign nations to surrender their most profitable state assets to Western banks and corporations? This is the ultimate financial colonization. This hidden history is the key to understanding why your economic stability is perpetually tied to the whims of unelected global institutions. Before we reveal the blueprint they use to seize control, take a second. Where are you watching this unfiltered truth from? Drop your city in the comments. And if you are ready to see the mechanism that truly runs your life, hit that subscribe button now. The setup for the IMF plague began in the 1970s. Global oil prices spiked, flooding U.S. and European commercial banks with massive deposits known as petrodollars. These banks desperately needed high-yield investments, and Latin America, with its urgent need for development and its easily influenced military regimes, was the perfect target. The loans were massive, complex, and almost always came with floating interest rates. The banks were driven by pure greed to lend money that developing nations couldn't possibly pay back, knowing that in the end, they were too big to fail. The crisis detonated in August 1982 when Mexico declared it could no longer service its foreign debt. This announcement shattered the illusion that sovereign debt was risk-free and triggered immediate capital flight across Brazil, Argentina, and Venezuela. This became the debt crisis, the lost decade, where economic growth stopped dead. And here's our first shocking parallel. The commercial banks were incentivized to make these reckless loans because they knew the global financial system could not afford to let major debtor nations default. Sound familiar? This is the exact same moral hazard we saw in 2008, where major banks issued toxic mortgages knowing the government would execute a systemic bailout to save them, not the homeowners. You see, the debtors were the nations, but the creditors were massive U.S. banks like Citi and Chase. When default loomed, it wasn't just a national crisis for Mexico or Brazil, it was an existential crisis for the entire U.S. banking system. So the IMF and the U.S. Treasury stepped in, not to rescue Latin America, but to execute a financial rescue of Wall Street. And this brings us to shocking parallel number 2. The solution was centralized control. Just as the U.S. Federal Reserve was created after the panic of 1907 by banking elites to stabilize their own interests, the IMF was deployed in the 1980s to enforce a centralized recovery. A recovery that prioritized creditor repayment over the well-being of the debtor nations. It seems the core structural solution to every major crisis is always the centralization of power to protect the lenders. The key mechanism for this takeover was the Structural Adjustment Program, or SAP. Countries were desperate for immediate cash to avoid total default and were forced to sign non-negotiable agreements with the IMF. These SAPs were not merely austerity plans. They were a mandatory, legal blueprint for economic surrender. The essence of the SAP was the Washington Consensus, a strict set of 10 policy prescriptions dictated by institutions in Washington, the IMF, the World Bank, and the U.S. Treasury. These included trade liberalization, deregulation, and, crucially, massive privatization of state-owned assets. The crisis had created the perfect financial weapon, the debt itself. The creditor nations used this debt overhang to enforce structural changes that had been politically impossible before the crisis hit. The critical decision that guaranteed the failure of Latin American sovereignty was the non-negotiable enforcement of debt-for-asset swaps. The creditor banks, who were in deep financial trouble themselves, were given the power to convert the sovereign debt owed to them into equity, which is an ownership stake in the debtor nation's most profitable, sovereign state-owned assets. The individual who championed these harsh, non-negotiable terms was a key figure in the Reagan administration. He saw the crisis as the perfect opportunity to enforce free market fundamentalism and transfer ownership to U.S. corporate interests, a figure entirely dedicated to the supremacy of the dollar. You won't believe the name of the man who guaranteed this debt-for-asset transfer, and the receipt is even wilder than you think. Let's delve into the weaponized mechanism that destroyed sovereignty, structural adjustment programs, and the debt-for-asset swap. The core principle is simple. The IMF plague was a mechanism of financial warfare disguised as a rescue. It ensured that the costs of Wall Street's reckless lending were paid not just by Latin American governments, but by the permanent transfer of their national wealth. The mechanism works in 4 stages. First, reckless lending. U.S. commercial banks lend petrodollars freely, ignoring the obvious risk that countries can't pay back floating rate loans. Second, the crisis trigger. Interest rates spike, debt servicing becomes impossible, and countries face immediate default. That was the 1982 trigger. Third, the SAP enforcer. The IMF steps in, offering a small amount of rescue liquidity on one non-negotiable condition: mandatory privatization and extreme austerity. This is the key structural mechanism of control. And finally, stage 4, the transfer of sovereignty. Creditor banks swap debt for equity in newly privatized, formerly state-owned enterprises. The sovereign asset is transferred to private, Western corporate ownership at fire sale prices. Let's look at the numbers. The total external debt of Latin America surged from $75 billion in 1975 to over $327 billion by 1982. That's a quadrupling of debt in just 7 years, fueled by reckless lending. The SAPs then mandated drastic cuts, up to a 30% reduction in government spending, removing subsidies for food and fuel, and lowering trade barriers. The resulting poverty and instability destabilized democracy across the entire continent. And get this, during the 1980s, due to these austerity mandates, per capita income in Latin America declined by 8%. An entire decade of structural impoverishment was enforced by the IMF just to ensure that the creditors got paid back. The ultimate target was the state-owned enterprises, or SOEs. Before the crisis, nations like Argentina, Chile, and Mexico controlled their own telecommunications, energy grids, water supply, and airlines. These were sovereign assets that generated internal revenue for their people. But in the decade following the crisis, over $100 billion worth of these state assets were privatized across Latin America. Telecom companies in Argentina, mining in Chile, banks in Mexico, overwhelmingly bought by European and U.S. multinational corporations. This was the engineered transfer of wealth. In Argentina alone, the privatization of the national telephone company and the national airline led to the transfer of debt obligations worth approximately $5 billion, while generating only $2.3 billion in cash. A huge sovereign loss, all for the sake of debt reduction. The illusion that this process brought long-term stability was crushed by subsequent crises. The SAPs only created temporary liquidity to pay off the commercial banks, but they left the fundamental economies weaker and more vulnerable to future shocks. By the year 2000, many Latin American nations, having privatized their key assets, still had external debt ratios that were as high, or even higher, than they were back in 1982. This proves the SAPs failed at their stated goal of long-term stability. The historical lesson is clear. When international institutions intervene, the core principle is always debt servicing and structural change, ensuring that capital is transferred upwards and sovereign control is diminished. So, the IMF plague wasn't an accident. It was a structural process of financial colonization executed under the guise of fiscal necessity. The historical lesson is that when private profit and public mandate collide, the public always pays the price. The solution begins not with protest, but with awareness. Stop trusting institutions built on self-preservation and begin protecting your own purchasing power. Buy tangible assets, reduce your debt, and understand that inflation is a feature, not a bug, of this engineered system. We are required to deny that the system is structurally compromised, but the very debt that fuels the Fed's existence is the chain that binds the American worker. We must ponder this question of our time. Are we wiser now, or are we just walking the same path in better suits? If you believe that history is not just the past, but an actionable blueprint for finance, share this video widely. Expose this hidden truth to your network. And subscribe immediately, so we can continue to unpack the hidden mechanisms that control your life and your wallet. Thanks for watching.